Okay, waiting on the phone for me, I have somebody who you can recognise very quickly. Hello.
Hello, Lisa. How are you doing?
I'm all right. See, the thing is, do I actually give you an introduction anymore? Because you're on my show so regularly now. Most people know who you are.
Well, it's my great privilege and pleasure to scare the heebie-jeebies, not deliberately, but I am sometimes called Mr. Realist.
Mr. Realist. Okay, for anyone who doesn't actually know who this is Jonathan Davis, and he's an economist and money manager, yeah?
I am indeed. I advise private clients on managing their wealth. Yep,
and every so often you pop into my show and we talk about the kind of headlines that you say you scare people, but I find headlines generally scare people. Today in the Daily Mail, 34 billion wiped off the FTSE as shares fall to a 15-month low.
Yes, indeed. I think that's probably yesterday's headline. In relation to yesterday's stock market.
Yes, it's a follow-up on that, yeah.
Because it rose a bit today, but in essence, the stock market is in a bear market. It's down something like 20% since the highs in the spring. And indeed, it's now 40% lower than it was 11 years ago.
Wow.
You know, people say to me, you should invest in the stock market for the long term, you'll make money. So I ask the question, how long is long term? In other words, the stock market is finally catching up with the reality of what's happening in the economy. It is amazing that all these banking and government or sovereign debt crises have been around for months, if not years, and yet it's only in the last couple of months it's finally hitting the stock market. Yes, people's pensions and savings are being affected. And people need to get to grips with this reality.
Now, under the headline that it is actually today's newspaper, it says the FT 100 index has now lost 18.3% of its value since early July, a fall of 1,110 points, or as I said, 289 billion. It's left savers, investors and pensioners, as you say, nursing heavy losses. If someone actually reads something like this or hears what you are saying, what on earth could they possibly do to try and get their personal situation sorted out?
First of all, they need to get real. I mean, that's what I find really surprising or curious about this whole economic thing. People have been acting like ostriches, sticking their head in the sand, hoping that it will go away. They have to get real. They have to look at their finances, and they have to question whether or not, just because, if we say 3 months ago, the stock market had been riding high since early 2009, if that seems reasonable, given that they must, of course, see the economic situation in Spain, where they live, and then they switch on the television and we see Greece. Ireland was bailed out last year. So they have to ask themselves, does it seem reasonable that my pension fund was up, this is 3 months ago, when all these things are happening and in the news, right in my face? And the answer is no, it's not reasonable, because the stock market does not forecast. It reflects ultimately what's going on in the economy. In other words, it happens afterwards, and they have to take action. Now that the stock market is down circa 20%, this is not the time to be selling, but I would say, I'm talking about whatever stock holdings they have within their pensions and their other investments, but I would say is when we see a decent bounce, and I suspect it will happen over the next couple or few months, then people should seriously be looking at their portfolios and reducing exposures to stocks and shares, because, and this is what your listeners need to really listen to, as far as I'm concerned, we are in a bear market, and next year is going to be at least as bad as 2008.
Really? Now, let's take it from an aspect that, okay, I'm a complete novice and I don't know what a bear market is. Is it literally what it says on the tin, or is there more behind it?
I sincerely apologise. You're absolutely correct. It's market parlance. A bull market is when the thing you're invested in is going up.
Right.
And a bear market is when the thing you're investing in is going down. And as far as I'm concerned, we had a bull market, a rising market from early 2009 till a few months ago.
Yeah.
We have now, in my view, in my professional opinion, we have convincingly entered a bear market, a falling market. But remember, nothing goes in a straight line. So although the market has fallen 20% in recent weeks, last couple of months, I think actually going into the winter, we're likely to see a rise, a rally, and that will be an excellent opportunity to significantly reduce holdings, and within your pensions, within your other investments, you can take action, you can preserve your capital, preserve your wealth by, for example, simply moving to cash. You don't have to cash in your pension, you just have to move the investments around within the pension, sell some and stay in cash. And that will preserve a lot of your capital. And that's what I'll be doing with my clients later in the winter.
What makes you think there's going to be such an upward trend?
Yep. Because the market moves in waves. It doesn't move in a straight line when it has a trend. The trend, as I say, for a couple of years was up. And if anyone just goes on, for example, I don't know, the Yahoo website or the BBC website and looks at, for example, the FTSE 100, the top 100 companies index, they'll see that over the last couple of years it was up, but it wasn't a straight line. And similarly, on the way down, which started, as you said, a few months ago, I think it's going to go way, way down, just like 2008, but it's not going to be a straight line. As I say, we've had circa 20% down. It might still be a little bit further in this particular move, started a few months ago, but I think that into the winter there'll be a rally because that's the way markets work.
Yeah.
And then once prices are higher again, then I think with the economic collapse that's happening, because I think Europe is in depression, then the stock market, I think, next year is going to crash, bang, wallop.
Crash, bang, wallop. Okay, hold on one second, Jonathan. We've actually got a call. Hello, caller, you're on the air.
Hello, good evening, Jonathan. Good evening, Lisa.
Hi.
Hi, Jonathan. A couple of weeks ago, you suggested, and I'm a fan of yours. You're honest. You suggested putting our money into dollars, and most of my money, our money, is in England, in the pound. I've got very little out here in the euro. Now you're saying put it into cash. I don't really fully understand how on earth do I go about doing this? I have no reputable financial advisor out here that I know of. I'm sure there are, but I don't know of anybody. I'm out here with nobody I know I can trust. I'm not on the internet. How do I go about doing all these things that you suggest?
Well, the two things I mentioned there, and you're quite right. I did say a couple of weeks ago on Lisa's show that people should consider seriously moving some cash out of the euro and or sterling into the US dollar. And it is interesting that the US dollar has strengthened in that time period. And I think as this bear market, as this stock market fall continues through next year, I think the dollar is going to absolutely soar. So how do you do that? Well, for example, a bank will be able to offer you a US dollar account, just like a deposit account in sterling, but instead it would be in US dollars. And so long as you've got a friendly bank back in Blighty in the UK, I'm sure they'll be able to do that for you.
Okay,
with regards to...
So I can just do it on I normally do telephone banking, so I could do that on the phone, could I, or something?
Well, it depends who your bank is, and if your current bank doesn't offer a US dollar account, then, well, there are lots of banks which do offer US dollar accounts. I mentioned a couple. Can I mention a couple on air?
Oh, go on then. I'll let you.
Metro Bank is the newest high street bank. Lovely bank. I love them. Metro Bank in London and HSBC, for example, they offer US dollar accounts.
Thank you very much, Jonathan.
I hope that helps, Sharon. Okay. Bye. See, when it comes to making big decisions about your personal finances, it's got to be the right thing to do is to get somebody who obviously knows what they're talking about. But as Sharon very well just illustrated there, it's always a bit of a worry picking the right one first, isn't it?
Well, I fully understand how difficult it is to obtain not just quality advice, but impartial advice. And what I mean by that is, in financial advice, commonly, the way to pay for it is via commissions on the purchase of products, or more like the sales of products. And that is not impartial. When someone calls themselves a financial advisor, but in fact they're trying to flog you a product and they take a commission for that, there's no way that is impartial. Now, undoubtedly, most people will have heard the phrase independent, but just because you're independent doesn't make you impartial. All that means is you're not linked to a particular financial institution. It is very difficult. I would say, there are 50,000 financial advisors in the UK, and I know a lot of them because I've been involved in the professional bodies. I imagine there's probably only 40 or 50 out of 50,000 that I would probably send my mother to if it came to it. It is very difficult. You have to hunt. You have to talk to people who have used. You have to go on the web, although the lady there says she doesn't have it, but you have to go on the web. You have to look at their websites. You have to look at their qualifications. You have to look at how they charge. And you have to look at and find out if they actually know what they're talking about.
How do you...
For example, did they say the stock market crash was going to happen? There's a simple example. Ask them if they said it. And if they did, get them to prove it.
Yeah, I mean, it's all very well doing all the research and everything, but if you don't ask the right questions when you're actually sitting down in front of somebody, you can still find yourself a bit of a cropper, can't you?
Absolutely, and the whole financial advice industry is largely run just like selling double glazing. I'm sure there's not much of that going on in Spain. We need it more than you do.
Yes.
And as regulated as it is, the regulation is like a chocolate, as useful as a chocolate teapot, because it's still about flogging products. It has been for 50 years, and it still is. As well as asking questions, you've got to ask yourself questions. Does this person, does this firm actually know what they're talking about? Do you have evidence of their views on markets and economics that they can provide to you that showed that throughout changes in economics, they are keeping up to date with it, and they are educating their clients as to what is happening? And I would say to you, the vast bulk of so-called financial advisors don't do it, and the reason for that, unfortunately, is because they don't know what they're talking about. They know about products. They know about pensions. They know about ISAs, individual savings accounts. They know about life assurance. But within the pension, the most important thing is not the product. The most important thing is the investment. If you get the investment right, the product's immaterial, because the product could be from company A, company C. It doesn't matter. What matters is, do you make money? And are these people making their clients money?
Yeah, absolutely.
There's one thing you should ask.
Definitely. Okay, hold that thought. We're just going to go to a bit commercial break, and we'll be right back.
This is Talk Radio Europe, your voice in Spain.